Hi, class. Welcome to Chapter 2, which is mutual funds. We'll get into what mutual funds are all about. So stand by. So I would think the first thing you are going to question is what it actually is a mutual fund. Well, a mutual fund basically is a common pool of funds, money coming from investors, and is basically contributed by individual investors. And the investors themselves are wanting to basically invest in a certain objective, which means long term, short term, passive, and so forth. So that's the beginning. Common pool of funds contributed by investors, and they are investing in accordance to their objectives. So investments are held by a trustee, which is basically a mutual funds company or management company. Okay, the investors alone are the joint beneficial owners. They're the owners. You individually may have 300 people, 4,000 people, a million people in a mutual fund. The investment firm itself manages it for you. So trustees oversee, again, the management by the investment manager. So there's an investment manager in a mutual fund company. That's the very beginning. The first concept is you want to invest in Apple, Google, but you don't have enough money, meaning each individual share could be upwards of $400, $500, $600. In that case, some people recommend you look into mutual funds. So what exactly is the structure? What do mutual funds do? How does it work? Well, the sponsor, which basically is to execute a trust deed. These are the trustees. These are the folks that say, give us your money, trust us to manage your money. That again is a management team. That is the efforts of a mutual fund management company. So you go ahead and identify, I'm the investor. I'm going to say I want to buy a mutual fund, but I don't have a lot of money. So I'd like to get into maybe a group of like-minded people who want to invest in several different companies. Mutually, we will have a mutual fund. Going back to what I said earlier, you have an asset management team, and the trustee is considered the custodian of the money, of the funds, of the account. So you have an agent, which is the distributors, the banker, you got to have the money going in and out through some kind of portal, so to speak, and then the fund accountants. Those are the folks that tell you what your money is doing. And those are the folks also that feed back into the management team, which will give them a heads up when you might want to move some of the money around. So how actually do the mutual funds really work? How does it work? So you have a group of investors, which are these folks right here. And so the investors say, you know what, I want to pull my money together, but I need to put it in the trust of someone. So it's all of us. This is Mike and Sarah, and I'm from Japan, I'm from America, I'm from Brazil. Collectively, we are the investors. We got a good amount of money, but individually, we can't probably get a good return on our investment. Chapter 1. So we're going to pool our money together, give it to this particular fund manager. He's going to invest it for us because he's got the knowledge, the skills, the insight to determine what particular securities and or stocks are best to invest in. That's our trust level. Then this allows us to generate a return delivered back to who? The investors. So that's the concept behind how an actual mutual fund works. But that's not the simplest, how do you say, explanation. There's more to it. Because now we got to get into the classification of mutual funds. Wow, what kind of classes are there? Well, based on your objective, there's based on the structure, based on investment objective, based on investment style. So here's the different classifications. So if you go with based on the structure, it's open-ended funds, closed-ended funds, and interval. I'm sorry, interval funds. Couldn't read that for some reason. Based on investment objective, do you want a debt fund? You want equity fund, building up some money, or do you want a hybrid kind of combination of debt fund and equity fund? And then you want to find out, wow, how about based on the investment style? Do I want to be passive fund, which means very little interaction with the management? The management just basically leaves your money in the pool, the mutual fund, and just leave it alone. Or actively, your active fund, which means you want this guy nonstop watching your money, moving your money around, that going to be the same fee? Because don't forget, the firm that you've hired basically is going to say, hey, we're your mutual fund management team, and we're going to be very active with your account. Whoa, how much does active mean? Find out what they charge, all the fees. It's a lot of fees that come out of mutual fund management teams. So here is more of a breakdown of the classification. So this is based on structure. So if we're saying the structure is going to be an open-ended fund, it means there's no fixed maturity date. Open-ended means anything can happen. Accept continuous sales and repurchase requests, which we're going to just keep going, going, going. Transactions are, which is NAV based, and unit capital is not fixed. Close-ended, this is the other structure you can think about, is run for a specific period of time. I want exactly 6 months of this fund, 3 months, 2 weeks, whatever you're going to stipulate to the management team. Okay, it's offered in NFOs, but are closed for further purchase after NFO. Okay, that's going to be part of the chapter. If you don't understand some of the acronyms, take a peek at exactly what they mean. And then here's the interval. The interval fund basically is the variant of closed-ended funds, okay, becomes open-ended at specific intervals and have to be much more monitored. So another classification based on your investment objective. What do you want to do? So I want to go with debt funds, which means invest in short and long-term debt instruments. Aim to provide regular income. We want regular income constantly coming in. Or we want to go a little bit more long-term, possibly with equity funding. So your equity funding basically invest in equity securities. Aim to provide growth and capital appreciation over long term. Hybrid investment is in a combination of equity and debt securities. Um, Proportions of equity and debt may vary, and aim to provide for both income and long-term appreciation. And finally, based on investment style, passive or active. So passive basically is to replicate a market index. I really want it just to keep doing what the market is doing. Whatever the market flow is, just go with the flow. This is called passive. No active selection of any stocks or sector. Expenses are very low because your brokerage firm is not doing too much for you. They're putting your money in these particular stocks and leaving it alone based on what you said is going to be your uh, uh, investment style. And then portfolio is modified every time index composition changes. Active, just the opposite, as you can read right there. So categorization of mutual fund schemes. So categorization of open-ended funds to ensure uniformity and characteristics of similar types of schemes launched by different mutual funds. You need to find out how they actually work. Okay, this also helps investors to evaluate different options available before making informed decisions to invest. You can take a peek at that schematic there and give you an idea of what you want to do. What scheme are you going to look for? The categorization of mutual funds, and we talked about that. So how do we actually invest in mutual funds? Well, it's several different ways that you can actually go about investing. You can invest on your own, off an app off your phone. You can go a physical mutual fund application form online. You can say I want to invest in this particular mutual fund. You can go via online mode, which is websites of mutual funds, mutual fund companies. You also can go through your mobile app through mutual funds. Or you can go through an AMFI registered mutual fund distributor using physical form online mobile app, which means you basically can hire a mutual to fund company, I should say, to manage your mutual funds. Mutual fund investment procedure. So, indicate whether you are a first time investor or existing investor. How much knowledge do you have in terms of the investment process? From there, you want to visit official websites of prospective mutual fund companies. Look at everyone that's out there. Go to Better Business Bureau and find out which ones are the best, which ones have complaints, which ones don't have a rating, and that'll give you an idea of which direction you went ahead. And Schwab is very, very, let's say, reputable. And there's so many other ones. E.F. Hutton, I can just go on and on. But that's for you to research. Also provide your details like names, address, etc. It'll give you information on the prospectus of the company. What have they been doing for the last 20, 30, 40 years? What is the return of the most average investment? Then you want to submit your bank account details, basically maybe a canceled check, so they can give your information for your account number, routing number, so you can have the money exchanging back and forth through your account. Once all documents are accepted, mutual fund company, basically, you can now start making investments through the mutual fund, passive or active. Investment models in mutual funds is a lump sum. There's several different ways that you want to start investing your money. Two are the most common, which is a lump sum investment. So a one-time investment. For me, I want to put in, say, $9,000 or $10,000 in a mutual fund, and I kind of want to leave it alone. And that large amount of money, I don't want to have to keep moving it around. So investors also face risk because of the volatility in the market. That's the lump sum. Now, here's another way you can stagger it out. Okay, you can actually do installments. Staggered investment period of commitment could be 6 months, 1 month, 3 months, 5 years, and so forth. That's when you decide you don't have 10,000, but you do have 2 or 300, and you'd like to maybe invest every 6 months, 2 or 300. So the investment team says, okay, we have your bank account information. We're going to pull a certain amount of money out of your account and invest it in the mutual funds that we've identified. So invest modes in mutual funds: direct mutual funds, regular mutual funds. You can see with the direct mutual are offered by the fund house itself, no involvement of third party agents, brokers, and distributors, no commissions and so forth. This is direct. You are investing. Regular mutual funds basically are bought through an intermediary, which basically these are the folks that actually charge commissions, brokerage fees, and so forth. There's also the people who know best what to actually select for you in terms of mutual funds. A lot of folks go with regular mutual fund itself. Then we have growth versus dividend option. A lot of folks like to go dividend option because they can have a nice payout. But your growth option, basically, the gains are made in portfolios are retained and reflected in the NAV. Realize profit is happening as well for your capital gains, and no increase or decrease in the number of units. That's going to be your growth option. Dividends paid out, funds declared dividends from realized profits. What actually happened with that mutual investment? Did you actually see a profit? So the amount and frequency varies and depends upon distributable surplus. And then NAV, which basically is going to fall after the dividends payout to the extent to the dividends paid. A little complicated, but that's where you have a mutual fund company to handle all this. And then dividends reinvestment option. You would put the money back in the mutual fund. That's possible as well. But it's up to you. I want to go back to the last chapter. I talked about YouTube University. When some of this becomes very, very confusing, you go to YouTube University and you say, hey, how do I actually create a mutual fund? How do I invest in a mutual fund? What mutual fund companies are out there that I should trust? That's when you actually get more knowledge. I would say the best knowledge, basically, in my opinion, is knowledge you gain from other sources, other people, the internet, because your own common knowledge will not allow you to be successful in securing mutual funds. So statement, the SAI basically contains all the generic statutory information of mutual funds. Everything about that mutual fund is going to be there. Your scheme information, which is SID, is basically the open or close-ended, the investment objective. What do you want to do with your money? Everything is spelled out for you so you're not confused. Our company at Southwestern College Invest, we have an investment company which is mutual funds, and every 2 or 3 weeks I receive a SID, which is basically a full breakdown of what's happening with my allocations. And it's very expansive, but it's tedious. I don't want to read all of that. I just want to know how my 15 stocks are doing or 300 stocks, whatever they are. But this is their obligation. They have to, it's a statutory requirement. They have to send me statements on a regular basis. So I'm very well informed. Here's the risk meter. This gives you an idea of what some of your mutual funds are doing. Low risk, which is 6 levels of risk for mutual funds, is low risk, low to moderate, and so forth. Then you have the ones that are very high. That just means that these particular mutual funds are a little more susceptible to having a little bit of higher risk and maybe some less return. And this is what your investment is all about. Finding out exactly how you can get an actual return on your investment based on your mutual funds that you actually have committed to. Well, folks, that is chapter 2 in a nutshell. Again, I give you a overview of what the chapter is all about. I expect you to read the rest of the chapter, which is chapter 2, review the rest of the PowerPoints, which are online in Canvas, and then from there, do some activities. Have a great rest of your day. I will see you in chapter 3, which is Introduction to Stocks.